Thank you for inviting me, and thank you all for listening. This is a keynote, so I get to speculate rather than do serious work. This effort, as usual for me, ran completely too long. So I'll advertise that there's a paper version on my website that does much more than I'm going to do today. And I want to take the chance to, when I was so kindly invited, there was a title about long-term investors and what they should do. So I want to try to think about what should we do for the supposed topic of this conference. How should long-term investors do what they do in dynamic markets? Now, this seems, from an academic point of view, this almost seems like a solved problem. Merton gave us the answer 52 years ago. You split between the market risk-free rate and state variable hedging portfolios. We have a dubious view of active management and its fees. Indeed, portfolio theory seems like such a soft problem, it's almost a backwater. Sorry, John and Luis, despite your wonderful work. Here we are at the NBER, the #1 place to do conferences, having a conference on asset management. And I count at best one paper in our whole course that has anything to say about portfolio theory and asset management. This morning has been, every model has been about the representative investor and why asset prices change, but not what portfolios should do, which is not criticism. These have been great papers. They're just, it seems like portfolio theory is a backwater because we have nothing to say about it. Now, I want to argue no. I want to say this is something vital and there's plenty to do. And that's, I suppose this is a cheering talk. And one way to see why I think there's something to do, let's compare theory and practice. We've had next to zero impact on the world. As you know, portfolio theory doesn't well describe what individuals do. Institutions are fun because we can see their process and we know, they tell us how they do stuff. And the way they do stuff has nothing to do with what we tell them to do. As you know, they look at our endowments. They put buckets by category, stocks, bonds, alternatives. They then rebalance very frequently. They seem to love illiquid stuff. They seem to love paying fees on top of fees on top of fees. One of our colleagues added up that Stanford paid $800 million in fees last year. And then every now and then, our websites, I remember the University of Chicago website said that, the endowment website said that they were the long-term investor who could wait out temporary market dislocations. 2008 came and they sold everything in a panic and froze hiring, which is happening again this year. As far as state variables silence, it's interesting. Most university endowments hire some very high-priced advice, us, to teach their students, and their endowments don't want to talk to us. I think they know the answers we tell them, and they don't want to hear it. So theory is very different from practice. And what do you do when theory is totally different from practice? Well, there's the Chicago approach, or at least the traditional one, which is, well, let's go find the question to which what they're doing is the optimal answer. And there's the Cambridge approach. I'm trying to keep this light, okay? Which is let's tell these morons that they should be doing things better. So I'm going to take a Cleveland approach. I don't want to call it a Stanford approach. It's halfway between the two. Certainly there is something on both sides. We could bring to practice, a lot of what I'm going to talk about is how to market portfolio theory, not how to do it. But clearly we could bring what we do to practice better. And while we're doing it, let's listen. And in fact, many of the things that seem to us irrational may tell us something about the problem they want to solve that we're not doing a good job of. And because we need to think better about how to implement portfolio theory and how to market it. And there's a fact, the expected returns and betas and so forth, that if you try to do that out of anything but a toy model, it just blows up. So how to do it, it's not, the theory is clear, but bringing it to work, you've seen what John and Luis have done and how hard it was just to solve that Merton problem. So I'll emphasize two big ideas here. First, I think we will either not necessarily do portfolio theory, but it will sell it better if we focus on the payoffs or the dividend streams, not one period returns. That's idea one. Idea two is actually bringing general equilibrium theory to the problem will help a lot. I think that our clients, investors, should think about who they are and what the market is, and that will help them to make a good decision. And there's all sorts of stuff we've learned about asset markets, as for example, this morning, since 1970. We can bring portfolio theory to that. We just have to complete the models and add some heterogeneity, and every paper has a portfolio theory corollary. So let's talk about the payoff perspective. So I was absolutely stunned when in 2001 John Campbell came to Chicago and gave John and Luis's classic paper on long-term bonds that proved that the index perpetuity is the riskless asset for the long-term investor. Now my reaction to that was, well, duh, that's obvious. And then my second reaction to it was, wait a minute, I didn't know that 3 minutes ago, and nobody in this room knew that 3 minutes ago. So that's the sign of a really brilliant paper. Congratulations, both of you. And then I'll admit to a twinge of jealousy, why didn't I think of that? Because it's now so clear. But what makes that clear is when you look at it by the payoffs. If you say a riskless asset is index perpetuity is a coupon that goes on forever, a real coupon, then it's obvious that's the riskless asset for a long-term investor. If you look at it the conventional way of looking at it, that yields on long-term bonds are a state variable for their investment opportunity set, and there's some partial derivatives of a value function out there and so forth. Now it's not so obvious at all, which is why John and Luis have to write a paper, not just state an obvious fact. Now, I think there's a deep insight in there, which has led me to think we should be at least communicating and matching to investors based on the final stream, as opposed to thinking in terms of hedging, state variable risk, and so forth, which an idea that they do not seem to get. Let me put it this way: suppose. Let's sit down for a retirement portfolio planning with your spouse, who we'll imagine is a infinitely risk-averse investor. And let's discuss what you're going to do. And of course, you're going to start with an indexed perpetuity, because that's the risk-free asset. And then you're going to build on that. And a month goes by, and the statement comes in, and it's gone down 20%. And your spouse comes in with saying, "What the hell happened here? Mr. or Miss Brilliant Finance Professor, you just lost 20% of our retirement savings on your risk-free asset. What's going on?" Okay, how do we have this discussion? Well, you could start with, well, honey, state variables for time-varying investment opportunities and the partial derivative of the value function and so forth. That conversation's not going to go very well. It's going to lead to, and isn't that what you said when you shorted Tesla last month? How about a conversation that goes, honey, look, let's talk about the payoffs. This is an index perpetuity. It'll pay us a coupon forever. It doesn't matter what the prices are. We're not planning to sell these things or buy more of these things. We're just going to live off the coupons. Would you start tearing up the statements and not letting them worry you? And that, I think, is a good way to have this conversation with a long-term investor. Similarly, stocks, it turns out, are a lot like bonds. That's another fact that we've learned. High prices relative to dividends are a sign of low returns. Stocks are, as John and Luis and others have taught us, a great hedge for their own investment risk. How can we sell that idea to our spouse? That we should be investing more in stocks as well as the long-term bond? Well, we could start in with this discussion about hedges for intertemporal opportunities. If the price is low, it's going to bounce back. We know that from some regressions and so forth. And we have the same hard discussion. Why don't we just say, look, we're going to buy these stocks for the dividends. Dividends are much more stable than prices are. So, and let's just ignore the prices and buy these stocks for the dividends. In fact, dividends are salient in a way that market prices aren't. We all kind of understand the dividends are connected to the economy. So you're taking on a risk, but it's the risk of long-term economic growth. We don't have to really think about where the prices are going. Now, technically, another way of putting this is we all know that the dividend yields forecasting returns is the flip side of dividend yields don't forecast dividend growth. So I think that flip side is an easier one to communicate. Here's a graph from Bob Shiller. And by the way, we don't have to talk about, another way of saying it is betas are all are discount rate betas. We don't have to talk about behavioral or rational here. It's just the fact that most price variation comes from expected return and does not come from dividend variation. So somewhere there's a quote by Bob Shiller. I remember the quote, not the source, but when someone asked, why should you buy stocks? He said, buy stocks for the dividends. This is his famous graph from his Nobel Prize speech. These are the ex-post dividends and the stock price. That kind of visually shows you that the stream of dividends that you can get from a stock investment is, in fact, if you're willing to wait for the long stream, is much safer than the actual price. In some sense, we might just define a long-run investor as someone who wants to eat the dividends. And this view, lots of supposed fallacies make sense if you take a buy for the dividends view. My mom, I used to try to help her with planning. She didn't have much money, but she had to live off of it. And she would always complain, well, honey, they're not paying dividends anymore. How am I going to live? And I'd say, oh, Mom, we've talked about this every year. You don't have to worry about the dividends. You're allowed to sell stocks in the new world. Well, actually, if you're a long-run investor, just living off the dividends isn't a bad strategy. Our index perpetuity investor, if they saw prices going up and sold, would be in a mess of trouble. Similarly, when I said prices are high, my mom would say, oh, those are just paper profits. They don't mean anything. And I would say, Mom, money's money. That's an old thing. Well, no, Mom was right. That's another way of digesting the proposition that stocks are less risky for long-term investors because the price volatility won't goes away. And it makes sense. So why do our endowments love to have these liquid assets? Well, there's lots of reasons for them, but one is you don't have to mark them to market. It's a device for doing what I advised, just tear up the statements and don't pay any attention to it. Now, in thinking about the theory, we need to remember that portfolio theory is also a payout theory. The Merton theory doesn't just say, here's the stocks you should hold. It also says, how should you eat? And when we look at the world, people, even finance professors, pay attention to the portfolio advice and pay no attention to the payout part of it. So in the classic portfolio theory, in 1952, Markowitz told us the classic one, and Merton in the IID case said consume proportional to wealth. People don't do that. Wealth varies 20% a year. Consumption varies 1% a year. People aren't following that advice. People actually, it turns out, are following some Merton advice if you think that price variation is transitory and does not fund a long-term consumption stream. That's in fact how, there's a lot of low-hanging fruit in finance. We missed the equity premium for something like 20 years because we looked at portfolio theory and didn't look at the consumption. Equity premium puzzle is all about that consumption is much more stable than portfolios. Institutions are on the other end of this thing. Now, institutions do follow consumption is proportional to wealth. They pay out 5% no matter what. But of course, Merton payout theory says marginal utility consumption should be proportional to the value of wealth, which depends on the state variables. So in fact, when the state variables are high or low, you should have a state-dependent payout rule in most cases. That depends on parameterizations. So this all led me to think about let's think about prices and payout streams, and that may help us to communicate to investors who we are not communicating to if we talk about hedge portfolios. So I tried to generalize John and Luis's paper. The risk-free asset is the index perpetuity. Therefore, what's the risky asset? It must be the aggregate consumption claim. And in fact, if we want to, let's think about portfolio theory, as I've written down in the first equation here. Let's just think about the stream of date and state contingent consumptions. And we know complete markets portfolio theory, that leads to a very easy portfolio theory. One period portfolio theory works perfectly in complete markets, no matter how state dependent and multi-factor and so forth the world is. So I tried to extend this to incomplete markets. I wrote down the problem here. We've got a set of X is now a set of dividend streams, and you can put those together. So let's think about the time and state dependent dividend streams that you want to buy. And again, we can do dynamic stochastic portfolio theory just in one period Markowitz thinking if we treat date and state symmetrically. And there's a two-fund theorem. Importantly to what I'm going to talk about next, you can hedge your outside income easily. What matters is cash flow betas. So you kind of put on all this price variation, you put on the back burner. Now, it's not quite that easy because, of course, there is dynamic trading. So a firm can, a investment firm can create dividends for you by a dynamic trading and payout strategy. But I think that's an advantage too. That's an advantage, not a disadvantage. There ought to be a good separation here of the mechanics of creating portfolios and then trying to match them to the institution or individual. And so we can choose among dynamic strategies, but characterize them by what's the set of the risk and the level of the kind of payouts that you can get. Let me give you my second bigger idea for today, general equilibrium. I think we should, first I'm going to try it in English. English versus finance is a good thing to do. Researchers, investors, advisors, we should all routinely state and think about a view of the economic function of financial markets, your place in it, why you should get a reward, and what justifies doing something different from everybody else. In our language, we should all think in terms of a general equilibrium with defined kinds of heterogeneity but when we do portfolio advice. I might ask, why in the world would you're trying to simplify things and you're going to complicate it all up with general equilibrium? Yes, because now when we go down and when you buy tomatoes down at the grocery store, you don't need to think about general equilibrium. You just need to know what's the price of tomatoes and how hungry am I today. Why is that's the way Merton portfolio theory works. The problem is we don't see the prices, the expected returns, the covariance matrix that are in the portfolio theory. And we have actually very poor ideas of what those prices are. So if you have an idea of the general equilibrium, that can cut through, I think, a lot of this uncertainty about what the prices are and your preferences are. If you go down to the grocery store, it's as if, suppose they didn't tell you the price of tomatoes and you have to wait 20 years to find out what did I pay for those tomatoes. Well, if you have a notion of general equilibrium that it's August and tomatoes are harvested in August and the prices are like, low, that's a good time to buy, then you kind of know, well, let's go buy tomatoes in August. So I want to do two things with general equilibrium. First, I think it provides a good set of heuristics for portfolio decisions and for our advice. And the most important one is the average investor theorem. The average investor must hold the market portfolio. You say, but in fact, that's a very deep theorem, which causes a lot of people to look like a deer in the headlights when they're thinking about portfolios. Because of course, that means that any deviation is a zero-sum gain, at least in a financial one. Now, maybe not a marginal utility one. That's got to get to marginal utility and give them financial. But for anybody who makes alpha, someone else has got to lose alpha. So when we're talking to, if someday the endowments would let us talk to them, that might be a place to start because it tells you something immediately clear. Sigma inverse mu doesn't work, but you know something immediately. If you're not identifiably different from average, you should be holding the market index. In fact, you should not even rebalance. Now, number one portfolio advice you always hear is, oh, we need to rebalance 60-40, we need to rebalance. Well, the average investor can't rebalance. Stocks go up to 80-20, someone's got to hold the 80-20. So rebalancing is a dynamic trading strategy that is a net zero alpha, and somebody is gaining, somebody is losing. Sigma inverse mu is hopeless. Now here, teaching MBAs did me a lot of good because for 20 years, I tried to come up with a reasonable portfolio maximization problem set, and I could never do it. And no matter how hard I try, and those of you who have taught MBAs or tried to do it know this, it just doesn't work. It's just so unstable. But if you for that reason, this is already a very useful piece of portfolio advice, rather than sigma inverse mu, which will send you all over to nowhere. Well, if you're not, how are you different from average? That really gets you somewhere. Now, of course, there's an answer to that. Everybody thinks that they're smarter than average, like the children of Garrison Keillor's famous Lake Wobegon, who are all above average. But of course, we know that half of the people who think they're smarter than average are deluded about that fact. So I wanted to try to put this in some aphorisms that we could bring to investors. The placebo test is one. If we talk to a portfolio advisor or do a portfolio maximization program, there must be a question to which the answer is hold the market index. Most of the time, there isn't. Sigma inverse mu. Trying to get the market index out of sigma inverse mu is really hard to do. It fails the placebo test. And most portfolio advice, when you say, okay, you telling me I should I should invest in covered interest arbitrage, who should be shorting it? And they look at you, well, everybody should be doing this. It's great. Well, that's not portfolio theory. Now we're back in the all children are better than average test. The who should sell test is a good one. I'm just thinking of other ways to say the same thing. If you go into a value manager who says, look, value, all the great alpha, you say, okay, well, who should be shorting this? Who walks into your office and you say you should be shorting alpha? If the answer is nobody, well, then now we got a big question to ask about just where's this advice coming from. I like to call it the look in the mirror test. Are you sure you're not the one who should be selling? We could call it the dinner with lions test. The motto is, if you're having dinner with lions, make sure you're at the table, not on the menu. Or the look around the table test. If you go play poker, somebody at this table is the mark. Make sure that's not you. And I'm going to apply some of those in a minute. For us, we need to remember now, as academics, I think this helps us too. Portfolio theory has to be all about heterogeneity. We have to state who should be buying and who should be selling. There is no portfolio theory for the average investor. The average investor holds the market portfolio. So when we do our models, we need to think, what are the dimensions of heterogeneity, and always have a reasonable person who's going to be selling for everyone who thinks we should be buying. So with having given some aphorisms, let me proceed to what I think we could actually do as academics. How do we incorporate the 50 years of wonderful things we've learned about the world of, remember, 1970, it's amazingly prescient of Merton to even talk about state variables, because everyone thought returns were IID. What are they state variables anyway? Well, we've learned that, boy, are there a lot of state variables, and there's multiple factors, and there's anomalies, and there's all sorts of interesting stuff. But we haven't really incorporated any of that in portfolio theory, because everything we've done, what's the portfolio theory in everything we've done? Hold the market portfolio. We look at representative investors who hold the market portfolio and think about how to prices adjust so that nobody does anything. Well, now that we've learned all that stuff about markets, maybe we need to open it up. In a sense, Lucas won. Lucas's brilliant idea. You don't need to do portfolio theory. We took that too seriously. In the good old days, there was portfolio theory and then equilibrium. And so the ICAP-M came with Merton portfolio theory. Once Lucas came along, we stopped doing the portfolio theory and just read things off of the representative investor. Well, maybe we need to go back and think about that. I'm just going to take a tour of modern finance and think about how we could use that and incorporate that, what it might mean for portfolio theory. What different views of the market there are, and how people have different roles in it, and what they may do. So let me just start to I know it's been a long morning, and I'll rev you up with something easy. Let's just go back to the Merton theory and put that hat on. So here, the purpose of financial markets is intermediation. There's people saving for retirement. There's firms who are issuing equity. That's its purpose. There is heterogeneity. The people in this model don't have jobs. They don't have businesses. They don't have outside income streams. They're just wealth maximizers. but they are heterogeneous in one way. They have different risk aversion. And so you need to write down a model with equilibrium and how are people going to be heterogeneous if you want a portfolio theory. And as you know, what comes out in the IID case, we come out with this beautiful two-fund theorem, which I've been hoping we could do in terms of long-term payouts as well. Now, already, that is a very useful general equilibrium for portfolio advice. Well, why do I say that? Like, sigma inverse mu does not work. It's taken years and years, decades of work. Again, I'm going to just use John and Luis's book as a touchstone, but many people here have worked on this stuff just to get the basics of the time variation into a sensible Merton theory. We still can't do the cross-sectional on the sigma inverse mu. But if you've got that equilibrium view in the back of your mind, you don't have to. There's just two funds, and I got to choose those two funds. And in fact, now how do I know where I go on the two-fund theorem? Well, now we'll take a survey and find out your risk aversion coefficient. We all know how well that works. Surveys of how people feel stuff is how you start down the road to behavioral finance, because they answer all sorts of crazy stuff. But at least maybe our investor could answer, are you more or less risk averse than the average person? Well, that might be a better way than saying, what are your hobbies? Do you like to fly hang gliders, or do you like to stay home in the basement? Which that doesn't work so well. Now, of course, people tend to say I'm less risk averse than average too, and then they tend to change their mind. But we'll get the time varying risk aversion in a minute. So let's let me offer then a completely different view of what markets do, and I'm going to offer like 3 or 4 different views. One completely different view is that financial markets do something else. I want to think here about outside income risk. The biggest thing wrong with Merton portfolio theory is that everybody who comes to the market has some non-marketed income stream. All wealthy investors all have small businesses or real estate or something else. Our institutions have our salaries. Every institutional investor has a liability stream. So that's like the first, other than not paying taxes if you don't have to. The fact of your outside liability stream is the first order thing. And you see our endowments panicking. It's because they still got to pay our salaries no matter what happens on the market. So let's put that fact into finance. And it's a fundamentally different view of markets. It says that markets are there as a giant insurance market. People want to hedge outside incomes or outside liabilities. That hedging demand creates non-market factors. If there's an average, a mass of people who want to short one industry or one kind of stock, that sends prices around. But now, so it's kind of like a thing we've talked about for a long time. Let's start portfolio advice by hedging your outside income stream. The problem with that, of course, is it's very, very hard. And the reason it's hard is because marking to market a non-marketed stream is very difficult to do. Given the dividends of the S&P 500, I don't think anybody in this room, if we couldn't see the price, none of us could come within a factor of 5 of what the actual price of the S&P 500 is. And even less can we say how much did that price change. There's no news in the cash flow, and yet somehow you're supposed to wake up and mark this down 50%. Nobody wants to do that. So that's the part in looking at one period returns that hedge outside incomes, because we can't mark those to market. That's where I think that's falling apart. But of course, so here the two ideas kind of fit together. If you look at dividend streams, then I think we can more easily find dividend streams. And it's a coherent, I started this one because at least it's a coherent and plausible, if not true, general equilibrium view. We know who's selling and we know who's buying. If you're buying value, somebody else, you need to at least ask the question, well, there's somebody else who I'm not exposed to value in my business. Somebody else is, they're selling, I'm buying. It's an unsettling view because it doesn't describe what happens. When you talk to value managers, they're not real clear on who should become, it doesn't yet pass the look in the mirror test. They're not really clear on who should be shorting value, and that goes for the other ones. And it's kind of funny. This is, I think, a very reasonable view of the world. But if so, why are we as a profession and why is the industry all so focused on finding price factors, on giving alpha advice to the measure zero mean variance investor, whereas everybody else in the market should be trying to hedge. So I think number one thing that we could do is really work on trying to help people to hedge these outside income streams. And it would the finance industry really wants to do this. They want to tailor a portfolio to you and charge you a fee for doing it, which is a reasonable thing to do. That would give a reason for fees and for tailored portfolios. Let me move on quickly to macro finance. What do I do? What about we've learned a lot in the last 50 years. I put up a partial list: recursive utility, habits, ambiguity aversion, cross-sectional risk, preference heterogeneity, rare disasters, technological growth options. Our view of the market and I'm emphasizing the theories, but you of course know the facts that motivate these theories as well. I'm emphasizing theory because we're trying to put general equilibrium theory in our thinking about this. Well, what are the portfolio implications of all this tremendous amount of work, including habits, my own favorite? Zero, nada, nothing. All of these models, the portfolio implication is hold the market portfolio, and when we see why prices might change. So what do we got to do? Add heterogeneity of an interesting type, as suggested by the models, and then we'll know who should be buying and who should be selling. Habits are the example I know best. You look at the asset prices in the habit model, and wow, here we go. Time varying risk premia, market timing, let's do it. Then you do the look in the mirror test, and you say, oh, wait a minute. My risk aversion went up just as everybody else's did. I sit on the market portfolio. But heterogeneity is natural here. Habits are a parable in some sense for debt or fixed streams of liabilities. So one view, what happened to universities in 2008? One view is they didn't realize they had this debt stream, our salaries. Their assets came closer to the debt streams, their ability to fund that out. So what did? Their risk reversion went up like crazy. Maybe you and me don't have such debt, so we should be, in a world like that, we should be buying, the university should be selling. And that gives us a view. Now, of course, if universities if they are that investor, they should be investing very differently. They should be investing in a way that reflects the fact of that time varying risk aversion, which they're not. Rare disasters is another good one to think about. Rare disasters is very unsettling. I think we seem to have a once in a century disaster every 10 years. Rare disasters means that statistics are hopeless. All that matters is the covariance during the rare disaster. Well, what does that tell? Well, again, it says let's add some heterogeneity. Who is and isn't exposed to what the rare disasters are? It also says we got to do economics. We got to do general equilibrium. You're not going to get anything out of statistics. Monthly betas aren't going to tell you anything about what happens in the rare disaster. And it says the other principle of asset management, you got to do more risk management. That the Fed does stress testing is very interesting. The most beautiful risk management, the models in the world are the value at risk models in banks. The Fed doesn't trust them. It wants to do some economic thinking and stress testing. That's a lesson I think we should apply as well. Of course, the models with heterogeneity have heterogeneity. Now, it may not be true heterogeneity, but that's one that's one place where this is working. Trading and liquidity is, I wanted to bring this up because there's a fundamentally different view of how markets work and what markets are for. Are markets there for issuing equity to fund investment and retirement saving? Are markets there as a giant insurance market? Maybe not. Maybe the whole purpose of market is to facilitate, let's call it information trading or speculation. Now that's a totally different purpose and a totally different kind of heterogeneity. There's informed and uninformed. And the only one I'll pay attention to, there's people who want to speculate or need liquidity versus long-term investors who don't. So portfolio implications for the long-term investor are stay out of this game, but you have to understand what the game is in order to stay out of it. Now, this, you might say this is small, but it's not necessarily small. We've seen these spreads all over the place. As one example, let's look at the spread between AAA bonds and 30-year treasuries. Now those, I left out credit risk, but it's not anyway. It's not going to, credit risk isn't going to change this. Right now, the AAA bonds are 2.6%. Treasuries are 1.7%. So you say, yeah, 90 basis points, and then he didn't do the credit spread and so forth. But wait a minute, that's not 0.9 of a percentage point difference. That's 53% better. If you look at things by what price do I pay for a dividend stream, the AAAs are 53% better dividend stream for the same price. So persistent liquidity spreads can matter a lot to long-term investment. Now you might say, well, wait a minute, what if the AAA, what if it's 2008 again and the AAA spread widens and I can't sell these things and you know, they become illiquid? And to which I say, wait a minute, you told me you were the long-term investor. Maybe we need to look at the look in the mirror test once more. And I'm talking to you, universities, who said you didn't need liquid securities and then you tried to sell it all in it. So the look in the mirror test is always very important. Now, I'm going to emphasize trading here because I think it's a hobby horse of mine that I think we haven't paid enough attention to. I was very inspired by the brilliant Lamont and Thaler 3-comp POM event, which I encourage you to go look at. It's a case where the demand to do a lot of information trading was so strong, pushed the price of one security up so high that you could see a clear violation of arbitrage. But the pattern is general. There is a strong correlation that we haven't paid enough attention to, I think, between high prices, low expected returns, and a lot of trading volume. And the kind of trading volume is it's high bid-ask spread. It's trading despite high bid-ask spreads. There's a sort of a churn, a frenzy of trading when people think they have a lot of information about something. So these are graphs from an old paper. This is the price and trading volume of NASDAQ and NYSE in the last bubble, or boom and bust. I shouldn't say bubble. Here's a cross-sectional regression. It's not just between the exchanges, on individual stocks. There's a strong correlation between a Fama-Macbeth t-statistic of 7.5 of price versus trading volume. So there's a emergent view in here. I think that small growth is just a terrible return, but it's where all the active trading is because it's where all the information is, or all the speculation is, at least. So what do you take of that view of the world? Well, stay away. Avoid that stuff. Avoid stuff with high market to book. And if you're taking a trading view, high turnover, lots of short demand, short constraints, lots of news, the sexy stuff. Stay away from Tesla and Bitcoin. Liquidity is a different thing. There's demand for trading versus supply of liquidity. So treasuries are liquid, there's a lot of trading, not because people have a lot of information about it, but because people don't have information about it. So again, you want to stay away from you want to, not harvest the liquidity premium, they say. I find, I find that one harder though for the long-term investor. I kind of know I'm not a speculator. Do I really know that I'm not the one who wants liquidity? Well, universities thought they were the ones who didn't want liquidity, and they turned out to be wrong. In this kind of thinking, I think it's very important to complete the model. And most of our models, although they're general equilibrium, they're not complete. There's some exogenous liquidity trade. We talked about this in the last paper. There's this exogenous demand for high frequency trading. Well, where does that come from? Now, if you're doing a model of the market, it doesn't matter. But if you're going to extend this to portfolio theory, you want to make sure you look in the mirror and that's not me. And for that, you can't just make it an exogenous demand for liquidity if you want to make sure that I'm not the one who needs that liquidity. Frictions, we also just talked about. This is the exciting new thing going on, as you all know, in asset pricing. I tried to put up some of the buzzwords here too: institutional finance, intermediary pricing, slow-moving capital, supply and demand. We'll see a paper tomorrow, price pressure, and so forth. Now, there, of course, what does this all mean for the long-term, long only for our endowments for retirement investors? There's a big potential here, which is why we put it in conferences like this. If there are institutional constraints and arbitrages and so forth out there, well, maybe we, the long-term investor, should be funding some of that and harvesting the obvious alpha that would come from doing so. I always get annoyed by these models where there's the investor, the intermediary, in the market, and I say, wait a minute, there's E-Trade. I can go there, so go there, harvest some of this stuff, get around the segment. And in fact, that happens. Large institutional investors have learned they should do securities lending, and they therefore harvest some of that small premium. So it's not a new idea. Now, this is thought for the future. This is a new and interesting literature, which hasn't really gotten to the point. But how are we going to bring this to the portfolio implication? Are we going to take that seriously and not just as an excuse? There's a lot of stuff that's sort of excuses for active management that end up not working out after the fact. So I do think we need to face the fact that it's very hard to find alpha in studies of active management. If you read the pages of the Journal of Finance, if you came down from Mars and read the Journal of Finance, you think, oh my God, there's alpha all over the place. Look at these anomalies. Mike, I can make this morning already. We had uncovered interest parity and a couple percentage points you can make by I forget whether it was by buying the oil companies or selling the oil companies, but look at all these anomalies out there. But then you go read the page of the Journal of Finance where they do studies of manager performance, and it's the same dismal story. There's just no alpha anywhere. So we got to take that seriously if we're going to take the portfolio implications of institutional finance seriously. Why are we bailing out the banks every 10 years and not them paying us off their arbitrage profits? Now, I think an obvious answer is that we just got to calibrate. I'm thinking like of the very interesting new supply and demand models. Just got to calibrate this, that the shock to prices is extremely persistent. So there's very little one period alpha, but then a good opportunity to buy a dividend stream at a low price. That may be one answer to it. There is, this is a case where theory is different from fact. Theory says we ought to be able to, institutional investors like Stanford's endowment, who pays $800 million in fees, keep getting that wrong, ought to be able to make a lot of money by investing in a hedge fund. If there's capital constrained intermediaries, we'll give them some capital, or start up for $800 million, start up a bank that can, harvest UIP for you. Why not? They don't do that. They don't even come close to that. They're liquidity demanders, not suppliers. So just why is that? I think we need to think about. And of course, we need to add sensible heterogeneity that includes everybody in this market if we're going to make sense of it. So this is more of a question, a placeholder. I wanted to bring up that there's Merton, and then there's fundamentally different views of what the markets are there for, why people are in them, why they're heterogeneous, why you ought to believe that you're going to earn something for doing something other than the market. This is the new view of finance, and our job at the next conference, where I hope Monika and Luis will find some actual portfolio papers, can incorporate this view. So let me close out. There are, I think, this is not a backwater, not a completely solved problem, but huge opportunities. Not just in us doing portfolio theory, but in marketing portfolio theory too. And I think those two things do go hand in hand. If you can't market it to your mom, then maybe you need to really understand the theory or the empirics better. I think, just to recap, I think putting on the view of the dividend view, the idea that the long-term investor wants a state and time condition set of cash flows, and thinking about what those are and how to buy them cheaper, even if under the hood we have complicated dynamic portfolio strategies with value functions, at least matching that thing to the investor on the basis of the final cash flow stream with some good risk management, making sure that you don't come up, for some reason, here we are, the markets didn't go down, and many universities have hiring freezes, and they are therefore, we have a savings, we have an investment cash flow correlation even with $35 billion in the bank that just makes no sense whatsoever. So somebody didn't think about the cash flows matching the stochastic nature of our outside income stream well enough. So think about things in terms of payoff. Think in terms of general equilibrium. Start start every portfolio discussion with the average investor theorem and how to avoid being on the table with the lions rather, on the menu with the lions rather than at the table. And as we look for the immense progress we've made in theory and fact, with the representative investor in the back of our minds, I think we're ready to start thinking about the same theories and facts, the same fundamentally novel views about what asset markets are there to do with heterogeneity in mind, and therefore to help on the portfolio theory. I tried to close with some simple advice: don't pay taxes needlessly. Don't forget the average investor theorem. Tailor portfolios to an understanding of why you're different than average. We got to start thinking about how can we in practice hedge outside income. I know there's been a lot of work on it, but it just hasn't worked in practice. I think we can work on it. Do some risk management, economic risk management. And fees is always a problem. We say don't pay fees. The industry collects fees. I always felt embarrassed teaching MBAs that they paid a lot of money for me to tell them the markets are efficient and you should just index. And then they had to go out and charge fees. Well, I think in this vision is a vision of an industry that does what Fidelity seems to want to do. Helps with things that are not just taking money from the other guy. Helps match people to portfolios that are right for their nature of heterogeneity and their views of, because there's still a view question of where they sit in the world and why the market owes them something. So maybe we don't have to feel embarrassed about sending students out to run. In fact, maybe we have some business opportunities for them. Okay, thank you.